Good morning, my dear students. This is Unit 2, class number 7, and today's topic is discussion regarding methods of new issue market. My dear students, in previous classes, we have discussed regarding the particular financial market, and also financial market is divided into two parts. One is money market, another one is capital market. If you talk about money market, there are different components are there. One is call money, commercial bill, treasury bill, acceptance market, and also some of the advanced form of money markets are commercial paper, certificate deposits, interbank participation, and repo instruments. My dear students, capital market is divided into two parts. One is new issue market or IPO market. Another one is secondary market or stock exchange. But in previous class, as regards to new issue market, we have discussion regarding the new issue market, the methods, or maybe the parts are the one is origination, another one is underwriting, and the third one is the distribution. In this way, the particular new issue or raising of funds or fresh issue or IPO can be made through this type of market. That is called as a new issue market. That is also called as a that is IPO market, and that is also called as a primary market. Primary market also other name of new issue market and IPO market. My dear students, if you talk about today's class for the methods of new issues, the new issues can be made through one market, that is primary market, and that is called as a IPO market. This can be made through first time market. This is also both useful for the new companies as well as existing companies, and the main source of acquiring or raising funds from the public to finance the modernization, expansion, or new type of business, or new type of business lines should be acquired with these funds are to be properly utilized. That type of market, that type of funds managements are go through the one type of market, that is called as a primary market, and that is also called as a new issue market, that is also called as a IPO market. My dear students, you see in the primary market methods, there are several methods are there. One is public issue, another one is right issue, bonus issue, and private placement, bought out deals, offer for sale, and preferential allotment, and electronic IPOs. These are the through which the funds are to be raised in the particular primary market. First one is the public issue. Public issue means the particular company issues different types of shares, and through which or funds are to be generated. Means that is also public issue may be divided into two parts. One is the initial public offer, that is IPO. Another one is the FPO, follow on public offer. IPO IPO means initial public offers, or it is a fresh issue of equity shares, or it may be called as a convertible securities, or it may be called as a existing shares or convertible securities by unlisted company for the first time. Means the unlisted companies are issues the particular type funds raising method are called as a IPOs, and the funds can be generated through the sale of shares to the general public through prospectus, and that type of fund generation are covered under the IPO, initial public offer. Another one is or initial public offerings. Another one is FPO, follow on public offer. This is useful for the existing company or listed companies are those who are registered with the stock exchange, if they may raise some of the additional fund, additional capital for expansion or new type of business formation or new type of products they can introduce in the market. For this purpose, the funds are to be required. That type of funds, funding methods are called as a FPO or follow on public offer. Next one is the what is the basic difference between IPO versus FPO? IPO, initial public offer, FPO, follow-on public offer. But the meaning, first one is the meaning. It means the IPO can be issued by the new type of company, or it may be called as unlisted companies, or FPO. Generally these type of securities, or it is can be subscription to the public or publicly traded enterprise by the only listed companies. Means issuer, it is unlisted companies, and FPO, this is listed companies. If you talk about the raising of funds, though it is first time from the public, it is IPO, and it is expansion purposes, that is called as FPO. If you talk about the risk is very high in IPO but comparatively low risk in FPO. But objective is it is raising capital for the new type of business purposes, but it is subsequent investment in for a expansion or modernization type of business. Another basis is predictability. It is less predictable. You cannot predict whether the particular type of share sustain in the market for a longer period of time, and in the FPO it is may sustain because it is existing company can somehow know how in the capital market or stock exchanges operations. They are very familiar with the stock exchange operations, so that it is predictability is more high in FPO and less predictable in IPO. Profit, another basis is the profit, higher than the FPO in the IPO, and that is this in the FPO it is lower than the IPO. Types means there are the equity share preferences shares are to be transacted in the IPO, and in the FPO there are two offerings are there. One is dilutive and non-dilutive offerings are covered under the FPO. This is the basic difference between IPO and versus FPO or follow on public offerings. My dear students, these public offerings as through made through the or public issue can be made through the prospectus, and this is a one document which is a it is a reflection of a particular company, and it is a way through which the funds are to be raised. It is a one type of documents which details about the company, like as a in the prospectus there are several means documentations are to be covered. One is address, registered office of a company, name, address of a company, means secretary, auditors, banker, underwriters name and address, date of opening, closing date of opening, declaration of issue of allotment letter, or board of directors and their bank accounts, and detail regarding the underwriter, who is the underwriter. Another one is a consent of the directors and auditors and bankers to the issue. The and also there is some of the resolutions regarding the at the time of authority for issue the shares, procedure and time schedule for allotment, and capital structure of the company, main objects and the present business operation of the company and its location. And there are several minimum subscriptions, means that is by way of any premium or issue or discounts of the shares, or detailed director including appointments, remuneration and disclosure practices of the promoters contributions. These are the some of the important items which are required, or it's a one type of brief reflection of a particular company in a particular document. That document is called as a prospectus. My dear students, prospectus generally there are different types of prospectus are there. One is a statement in lieu of prospectus, another one is a deemed prospectus, another one is a arbitraged prospectus are there. But statement in lieu of prospectus and prospectus, there is a two basic difference of two types of prospectus are there. Another two are there. One is a deemed prospectus, another one is arbitrage prospectus. If you talk about various categories of prospectus, first one is a statement in lieu of a prospectus. Means sometimes the company does not raise capital by the public issue, means they are not issue the prospectus, and they are type of one document which is prepared, that type of statement or in lieu of prospectus is prepared and which is filed with the register within the 3 days of the allotment of shares or debenture is made. That type of documentation are called as a prospectus in a statement in lieu of prospectus. Means sometimes company does not raise capital by public issue or need not issue the prospectus. That type of documentation is required, that type of statement is required, that is called as a statement in lieu of prospectus. Another one is a deemed prospectus. Deemed prospectus according to section 25 of the Companies Act 2013, which provides some documents containing shares, debenture, all for sale, which are included in all terms with the prospectus, that is called as a deemed prospectus, and which is implication of the law. Another one is arbitrage prospectus. This is the section 2 of the subsection 1. It means it is a memorandum containing silent features of the prospectus and maybe by the SEBI by making regulation in this behalf, that is called as a arbitrage prospectus. And these type of there is a no form of application for purchase of any securities, and this type of there is a copy of prospectus shall request and made in person subscription list that furnished to the him. I mean, this type of, it is not a prospectus, it's as per the SEBI guidelines. Some of the regulations are can be kept at a some containing silent features are there, that is called as arbitrage prospectus. My dear students, second one, another method of issue of or raising of funds, that is called as a right issue. What is right? Right always kept with the or sub side with the existing shareholders. Means sometimes the company issue the shares to the existing shareholders or additional funds requirement without going to the public or without raising funds from the public. It can means it can put a good faith upon the existing shareholders on concern of some proportion of the shareholdings. That type of buying or that type of existing shares of a company with a discounted price or with a particular ratio can be made, or with type of a positive mode towards say existing shareholders, that type of shares or that type of fundraising issue called as a right issue. If you talk about the right issue, that's there is some fixed date or effort on a record date is required, and this right issue can be made some of the means existing shareholder when the company has an face of any liquidity crisis or any other problem arises. Means right issue always focus towards the existing shareholders. Another one is some of the advantages. What are the advantages? It is a cheapest mode and it helps the promoters, and it's a fundraising, new type of fundraising methods, and it is a another disadvantage is there is a stock exchange is put on restriction on the amount of there is just some of the advantages are there. Means and disadvantages are stock exchanges put a restriction on an amount, there is some restrictions are there, and value of each share may be get diluted after the right issue. and it's create a pressure on the company. There are some of the problems or disadvantages on in the right issue. Another method of raising of funds are called as a bonus share. Bonus issue or bonus share, the similar meaning. Bonus means it is a additional shares to the existing shareholders for free, or this type of issue is made companies free reserves, or it may be called as a some of the securities premium account, that is called as a bonus share. Bonus issue means it's a issue to the existing shareholders or for free, that is through which the funds are to be also raised. Another one is the private placement. Private placement means, what does it mean? It means in private parties. Who are the private parties? Some of the bankers, some of the institutions, some of the financial institutions, some of the large buyers, and to help the share brokers. In this way, this is just, ultimately it is similar to the offer for sale method, and it is also a, called as a higher price to the individuals or institutions through which private parties can directly purchase the shares, or any type of raising of funds, that is called as a private placement. And there are several advantages are there. What are the advantages? There are advantages. It is less expensive. Private placement is, it's a very easier way um, to the funds raising method, and also smaller companies generally find the private placement of the securities, it is a convenient way, and it is a highly beneficial to the public. And what are the problems? There are several problems are there. Yeah, generally it is artificial scarcity of say securities are there, and securities are concentrated on few hands. Means some of the persons are only only the tech part in the participant in this type of securities market, the securities way of securities raising of funds, that is called as a private placements. There are some disadvantages there. My dear students, another method is, in previously we have to discuss, the first one is the public issue, second one is the right issue, third one is the bonus issue, and fourth one is the private placement, and fifth one is the brought out of deals. Brought out of deals means the issuer makes a outright sale of a chunk of equity shares to a single sponsor. Means some of the lead sponsors are there, some of the lead bankers are there, some of the lead specialized financial institutions are there through which we can raise the funds. Means some of the parties are there, they may be called as a promoters of the company, may be called as a sponsors of a company, may be called as a co-sponsors of the company. Means these are somehow called as a banker, somehow called as a financial institution, somehow called as a NBFC firms, somehow called as a type of institution through which the funds are to be managed or raised, that is called as a brought out deals. But several features are there. Several features means, you may be, they may be called as a sponsor and co-sponsor or promoters, or several features means they may be a single sponsor or maybe a lead sponsor, and their sponsor has an separate syndicate with the merchant banker, and to meet the requirement and distributing the risk, and they sell the securities, which is some of the, it's a promoter's images and reputation, current market sentiments. These are the some of the factors which can influence the sale of securities through these brought out deals. Bought out deals and or brought out deals in nature of funding through which the merchant banker get locked for at least a minimum period, and the investor can realize the price when the price get listed and the higher price prevails, and the listing is done through the performance of the company. Means some co-sponsor can take participation in the brought out deals or bought out deals. That the similar lines of approach as regards to the fundraising method. Another, there are benefits. What are the benefits? One benefit is it's very low cost of sale of securities, and some promoters have freedom to realistic price valuation is very easier, and it's a better investors protection, and it deals with the quality of primary market offerings. Their prices can be stabilized in properly. These are the some of the benefits, but some of the disadvantages are there. The disadvantage advantages are there are only a control of a one large chunk of the shares, means some sponsor may control the particular type of share. Some sponsor can control the market also, means, and some wrong appraisal or project is also leads to a loss to the sponsor, and there is no adequate guidelines in this regard, and there is a sponsor can earn windfall for profit at a cost of small investors also. They can earn some profits also from this way. These are the some of the methods, and first one, that is called as a public issue. Second one, that is called as a right issue. Third one, that is called as a bonus issue or bonus share. And fourth one, that is called as a private placement. And the fifth one, that is brought out deals or bought out deals. And sixth one is the offer for sale. Offer for sale, it is a offer for sale, it is also a mechanism which is introduced by the SEBI in 2012, and this mechanism is useful for only the top 200 companies. In this way, offer for sale means the promoter in a public company can sell the shares and they reduce the holdings. Holdings means promoters holdings can be lower, and the promoters can or group of entities can lower their shareholdings, and it can sell to within the 3-4 days through IPOs, and that type of while the IPO remains open for 3-4 days, offers for get over a single trading day, means after 3-4 days open of IPO and FPO, then OFS, offer for sale, can made. These type of promoters holding to converted into extended to non-holding, mean non-promoters eligibility, that can be made, that called as a offer for sale. It's a one type of mechanism. Suppose for example, offer for sale means that is a sale of stake. For example, if the government wants to sell the particular raising of funds, some crores of the Steel Authority of India or ONGC or Coal India, some sale of some 5% stake or 2% stake or 3% stake. That type of pattern of selling of stake of ownership pattern can sold out to the public, that called as a offer for sale, through which the funds can also generate. Means how far the company raising the funds, one is public issue, another is the bonus share, another one is the right issue, another one is a private placement, another one is the offer for sale, another one is the brought out deals. These are the way through which the funds can be generated. Another one is advantages in the offer for sale are, there is no need to fill the application form. There is, and the shares can be allotted only 1 day or 2 days, so that T plus 1 means trading day 1, and there is no allotment. And it's a more transparent, and for the IPO, and the system is it's on a real time basis also. But another method is there for raising of funds, is called as a preferential allotment. Preferential allotments, you can the listed companies can preference to the some specified groups, selected groups, or selected pricing method is done, locking period is done, disclosure is done, specific purposes specified on preferential allotment can be made. That is called as a another way for raising of funds. Another one is a qualified institutional placement. It is a one method, qualified QIP, and qualified through qualified institutional placement. So company which are listed in the stock exchange, They may be the issue shares or debentures or any kind of securities through the in different methods, that is called as a QIB or QIP, that is called as a qualified institutional buyers are there and qualified institutional placement are there. So that qualified institutional placement can be divided into two part, one is QIB, another one is QIP. If you talk about QIP, qualified institutional placement, it means the equity shares of a listed firm or a promoters of a listed company. They may allocate some of the stakes or some of the shares made through the qualified institutional buyers. Means some of the buyers are involved to purchase these type of stakes. That type of placement program are called as a QIP or QIP means qualified institutional placement programs are there. Qualified institutional buyers means who are the buyers? They may be the mutual fund, they may be the venture capital fund, they may be the bank, they may be the national investment funds, they may be the insurance funds, or they may be the provident fund. Means that this type of a placement program, these through the qualified institutional buyers can be made through this type of quality in a such type of institutional placement of raising of the funds. So my diagrammatic show says the kinds means there is a institutional placement program through qualified institutional buyers. Another one is the EIPO and green shoe option. These are the new type of methods through which the funds can be raised. EIPO means electronic initial public offerings, or that is offerings through the online systems of the stock exchange. The now the companies are allowed to issue the capital to the public through the online system according to the security or SEBI disclosure investor protection guideline 2000, through which the funds also can be raised. Another one is the green shoe option. It means it denotes an option for allocating the shares in excess of shares, including the public issue. Means the SEBI also guidelines to allow the issue of share as subscription ceiling with 15% offer made to the public. Means through green option means that is called as in excess of shares which are only 15% to the public. This is also a not generally famous, not in India. This is extensively used in the international IPOs to establish the post listing the prices of new issued shares. So through which the green shoe option also another part of a raising of the funds by the, or it's a way of a public issue management. My dear students, and somehow some other type of methods are there in the public issue management. But even in public issue management, one is public issue through IPO, FPO, another one is the bonus shares right issue, another one is the private placement, brought out deals, offer for sale, another is the EIPO and green shoe option, and another one is the institutional private placements methods through QIB. These, in this way, the particular the primary market can fund raising the funds, and the raising of funds can be created or issued to the public for sale of IPO through prospectus. There are we have discussed regarding detail regarding the prospectus, what prospectus contains, and how far it is beneficial for the at the time of raising of funds by the company or public sector institutions or governments to raising the funds. And these funds are generally injected by, or it's utilized in form in new type of project or expansion and upgradation or modernization of the existing projects. My dear students, today's class for the only methods of public issue in the public. There are several methods are there through which the funds are to be generated. And thank you. If any question, you can ask me.